I didn't brief them on that one. Right, okay, our speakers are up there. And first up, we've got no less an Australian. Ben Burston to give us an economic review. Justin's going to cover capital markets. We've got the sector roundup from Ridian and Catherine. And then Chris is going to give our policy overview. I hope you enjoy it.
Well, good morning, all. Thank you very much. Thank you very much, Jeremy, for the introduction. I wasn't going to mention the rugby, but of course I won't need to remind anyone here that just last October, I think, both Australia and Wales came away from Twickenham with the goods. So there you have it. Now, this morning I'm just going to aim to set the broad picture, set the scene of the broad economic outlook for the UK, for Wales and for Cardiff, and what this means for the property market, and of course for you, our clients, in 2016. I'm pleased to say that the UK economy remains on a very solid growth path. The fundamentals that have carried us through over the past 3 years remain very firmly in place. In fact, over the past 3 years, since 2013, we've had very strong growth, and in many ways the wind continues to be in our sails. We've had rising real wages, sustained period of low inflation, a period of strong business confidence and improved business investment, and all of that has provided us with very strong momentum up to this point. The economy is estimated to have grown by 2.2% in 2015, and we've seen record job growth over the past few years. So solid GDP growth, but really exceptional labour market performance. The strongest period of job growth we've seen for around 30 years nationally. And of course, that's provided ample support for the office leasing market. That sustained low inflation I mentioned, that's provided a very strong backdrop for consumer spending, for retail sales, and of course that's underpinned demand in the retail sector, but also for distribution and logistics. Within the UK context, Wales has seen very strong growth. In fact, of the 12 UK regions over the past 5 years, Wales has been the fourth fastest growing, a little bit behind London and the South East, but ahead of just about everywhere else. Looking ahead, the base case outlook is for more of the same. The growth expectation for the UK is from Oxford Economics, but similar figures from most commentators at the moment. The forecast is around 2% growth for 2016 and much the same for Wales. So fundamentally, the outlook remains very supportive, and that should continue to support our market just as it has done over the past couple of years. But clearly, there are risks. And it probably won't come as too much of a surprise to you that I think there's two that are foremost in the mind of most market participants, most clients we speak to, and indeed policymakers. Firstly, the risk of a global economic slowdown, perhaps triggered by emerging market weakness, and the implications that that might have for the UK. Now, at the turn of the year, equity markets took a real hammering. Since early January, over the past 2 months, FTSE was down by 10% at one point. It has since recovered. But we saw similar falls globally, led by the Chinese stock exchange, which fell by around 20%. And the reason it fell is due to concerns around the stability of global growth, concerns over global aggregate demand. Are we seeing strong momentum in the global economy? And of course, that was also reflected in the steep fall we saw in the oil price. And that's something I mentioned last year, that the oil price had fallen a lot during 2014, but it fell even further over the past 4 months. However, some perspective is needed. China is still growing at around 6.5%. The latest data from the US economy indicates that, just as we experience in the UK, momentum in the US economy is quite strong. Europe is forecast to do a bit better this year. So even if, and indeed the Chinese economy has slowed slightly already, but even if it was to fall a little bit below expectations, the feeling is that there probably is enough support from other regions to broadly maintain the same pace of global growth. So while of course we'd like it to be better, and improved global growth performance would make it much easier to sustain our current momentum here at home, but we shouldn't feel too pessimistic about the global outlook. The expectations are it'll be much the same pace of growth this year. The second risk is uncertainty over our future relationship with Europe. Now, you don't need me to tell you that this is a vexed question, and the economic impact is highly uncertain, and that impact in turn would depend, in the event of an exit vote, on the outcome of a convoluted and most likely very lengthy political negotiation that would of course be required to reach a new settlement with Europe. And it's of course worth mentioning Europe is far and away our major trading partner. So what can we say about the property market impact? Well, firstly, markets in general don't like uncertainty, and we shouldn't expect the property market to be any different. UK-wide, we expect to see lower take-up of commercial space this year. We would also expect to see lower turnover in the investment market, as some participants will most likely choose to sit on their hands and wait until the result is known. Indeed, JLL's network of offices is already reporting that some corporate requirements are being put on hold for a few months. In the event of a vote to remain, I would expect that the event would really fade quickly into memory, and we would have a very strong second half of the year. On the other hand, a vote to leave would not be the end, but rather the beginning of a new period of uncertainty. And even for those believing that the exit would have long-run economic benefits, most of them would acknowledge that the path to get there would not be without disruption, with the potential to directly impact key sectors such as banking and financial services, with particular implications for London, of course, and the automotive sector in the regions, to pick just a couple of examples. Now, whether the future has the UK in the European Union or not, the key to unlocking sustained growth in our cities lies in creating strong clusters of businesses, preferably in fast-growing industries. We've very much seen this over the past few years in the very rapid growth that we've seen in the likes of Cambridge and Manchester. And Cardiff's also benefiting here as it continues to develop as a location for financial and professional services, which of course has been highlighted by the expansion of Deloitte and Admiral in the city centre recently. Now that sort of growth, accompanied by increasing urbanisation, which is a trend we see right across the UK, that will continue to propel faster growth here in Cardiff than in Wales overall. And in addition to that, we would expect the proposed improvements to infrastructure, the electrification of the Great Western Main Line, government efforts to boost research and development, including such as funding for the Institute for Compound Semiconductors and investment in digital infrastructure. All of that should help to support growth and innovation over the medium term. So what does all this mean for the market in 2016? What is our outlook for market performance? For the past few years, reflecting that very strong economic performance, we've been flying high. At the UK level, we've seen 3 years of double-digit total investment returns as measured by the IPD, 18% total return in 2014, followed by a 13% total return just last year. We've seen that growth across all sectors, across all regions, across both prime and secondary. So we've had a very strong run. Cardiff's delivered very strong returns as well, with the office market delivering a potent combination of yield compression in 2014 and rental growth in 2015, registering total returns of 15% in each of the past 2 years. In 2016, we expect another year of solid returns, but we'd expect those returns to come back down to earth a little. It's going to be much more difficult to hit double digits this year. We'll be back where property generally should be in terms of long-term average, high single-digit returns, but still very strong relative to other asset classes. We may see a slight slowing in economic growth in the first half of the year, reflecting some of that uncertainty I mentioned. But we expect the fundamentals of job growth and rising real wages to very much continue to support the market. In addition, the lack of new supply we see across all regional cities will very much remain in place. That will continue to spur rental growth and encourage new development. In a world of low interest rates, it's very much our view that low yields can be sustained, but after sustained compression, the outlook for yields is more stable than it was a year ago. Cardiff remains good relative value, with high yields than in other regional cities. So in 2016, we'd expect high single-digit returns driven by rental growth and solid income. The market will keep moving, but at a slower pace, which means you'll need to work your assets to outperform. I'll now hand over to Justin and the rest of the team to tell you how to do that.
Thank you, Ben, and good morning, everyone. Well, I'm not expecting any sympathy, but this is certainly a familiar sight after 2 consecutive years of record UK investment volumes. Investment agency really isn't as easy as it looks. There are, however, signs that the UK market was cooling, or there were, however, signs that the UK market was cooling in the second half of 2015. That said, this overall slowdown does conceal very different performances, both by sector and region. Wales was a standout regional performer in 2015, and the total Welsh investment volume pushed past 1 billion for the first time ever. That's 136% ahead of the annual average since 2007. Offices in Wales were in the spotlight, jumping from 20 to 37% of the total Welsh volume, with a flurry of transactions in Cardiff alone. An imbalance between supply and demand was addressed, with the release of key assets and also the unblocking of the development pipeline in Cardiff. A strengthening occupier market, a return of rental growth, and the tightening of secondary supply have all helped to drive the market. These are some of the key Cardiff office deals in 2015. From super prime to secondary, Admiral actually setting a new record yield for the city. Central Square was the highest profile deal of 2015, with L&G investing into Rightacre's master plan. It included the forward funding of 1 Central Square and also the new BBC HQ. Cardiff office investment volumes were a staggering 425% ahead of the 5-year average. Outside of Cardiff, we were involved in the sale and acquisition of these 2 Grade A assets. The Airbus campus was acquired by a syndicate of Dubai-based investors, whilst Admiral's Swansea HQ was a strategic purchase for the University of Wales Trinity St David. A large proportion of the industrial stock in Wales is held between a relatively small group of large-scale landlords. Magellan Court is one of the few individual estates or single-let units that was traded, and there's certainly a pent-up demand for well-priced prime and value-add opportunities in the industrial sector. Industrial portfolios remained an important part of the market, with deals including Hanstein's HBUT 2 sale to Brockton and Dunedin, and IPIF buying the Fixed Trade Park portfolio, both containing significant Welsh assets. Despite the rise of offices, retail still accounts for a dominant 40% of the total investment volume in Wales. MacArthur Glen was 2015's headline deal, together with the sale of the Morfa shopping park in Swansea by the Crown Estate. On the High Street, the prime deal was the Matalan on Queen Street, but there remains an exaggerated gap between prime and secondary yields. Moving on to some key themes. The corporate real estate debt market has become highly liquid, with the greatest variety and number of lenders there has ever been. Debt origination reached its highest level since 2007, and whilst this is good news for debt availability this year, there are concerns that history could be repeating itself. The weight of money in the last 24 months has far outpaced the amount of stock, leading to both yield compression and overheating in some subsectors of the market. We see a more balanced market in 2016 as investors reposition their portfolios for greater exposure to rental growth, and this really should lead to some market churn. A growing list of key Welsh assets has traded in the past 24 months, and we need to see the creation of new good quality stock to sustain volumes and to satisfy investor demand. Whilst the Cardiff office development pipeline is in full swing, we need to see more development right across the South Wales region. After Scotland, the proportion of overseas investment in Wales was greater than any other UK region in 2015. This slide shows some of the reasons why the UK remains one of the most popular destinations for cross-border investment in the world. In a UK context, Wales looks attractive as investors seek out value. A global market, however, means greater exposure to global risks, which Ben has touched upon this morning. And all these factors could impact on the UK property market. In particular, the impending vote on Brexit is creating uncertainty, and this will certainly lead to a pause in investment decision making. Looking ahead, we think that the cooling market, particularly amongst the main retail funds, is a pause as opposed to a correction. We anticipate more equal supply and demand, with market churn created by portfolio asset management. Political and global events will influence the market, and the uncertainty around Brexit will most certainly have a negative impact. And on a final note, I think we really do expect another good year next year, and whilst I'm happy to be proved wrong, we're unlikely to hit the heights we saw in 2015. Well, that concludes the capital market section, and I'll now hand you on to Rydian to begin our sector roundup.
Thank you, Justin, and good morning all. So, to the office market. 2015 was certainly a good year, with property commitments from all of these companies throughout South Wales. The property investments of the various companies listed directly relate to the following themes, which I will touch on during this presentation. These themes reflect a trend in both the UK regional office market and South Wales. Moving on to Cardiff, take-up was recorded at a record level of 616,000 square feet, which was made up of 121 deals. But out of the 121, 112 were on behalf of companies taking 10,000 square feet and under. Spare a thought, therefore, for us poor agents chasing fees on these many small deals. Moving to the complete other end of the spectrum, the BBC pre-let was confirmed in November last year. This is excellent news for Cardiff, and especially the regeneration opportunities this brings. Other key deals relate to the letting and investment made by these three companies. The out-of-town market was unfortunately the weak performer, with take-up equating to only 20% of the Cardiff total and 41% down from the previous year. Robert Hitchens were delighted to welcome Pal Dobson to Eastern Business Park, which was the largest out-of-town letting. We anticipate a better year for out-of-town in 2016, particularly due to the limited city centre supply. Total supply stands at 1 million square feet, with only 40,000 Grade A. This low level was being addressed this year by the introduction of 260,000 of new space, including Ardstone's 2 Kingsway refurbishment shown here. However, the high level of demand at the end of last year has already taken out most of the new supply. This activity has resulted in both Rye-Takers and JR Smart announcing further phases totaling 215,000. The occupier and activity and low supply has already seen Grade A headline rents increase from £21 to £24. The gap in the market remains for good quality office refurbishments, and reversionary rents are finally here. Asheville's Castlebridge scheme is a prime example of this success. I should also point out that the grads looked at me rather blankly when they saw reversionary on this slide, which I had to explain means rental growth. However, office refurbishments continue to be under threat from the alternative sector, with 400,000 square feet of office space taken out of the market over the last 3 years. I was advised by my colleagues and my daughter not to attempt a Yoda or Darth Vader impression. But as Yoda would say, the dark side is strong. However, the big question, for how much longer? Turning to Newport then, take-up stands at 130,000, which is a 10% increase from the previous year. The key transaction was the sale by JLL of the Alcatel-Lucent building to Sir Terry Matthews Celtic Manor Resort. In addition, Qualification Wales acquired 10,000 square feet at Q2 Imperial Park. And for Swansea, out of all the 3 cities, Swansea experienced the highest percentage increase of nearly 100%, but stands at only 116,000. The key transaction was the purchase of this building by the University of Wales Trinity St David. In addition, ERS acquired space at Crucible Park and TUI expanded at Alexandra House, which is great news for the city. I will now move on to some key themes, with demand being a strong contender. Demand going forward will continue to be driven by these 2 sectors. And although the public sector are far from expanding, they are here to stay and will always need office space. But consolidation will be key. This leads me on to the GPU hubs, which are certainly a reality and will have a massive impact on the office market, with South Wales to benefit also. JLL is delighted to have been appointed on the GPU project. These 5 companies are real examples of regional relocations from outside London. South Wales also boasts a major inward investment, with Deloitte relocating an operation to Cardiff. London is being faced with a dilemma, with the following key issues. And surely the space shortfall and lease expiries will enhance the Welsh opportunity. Wales strongly competes in all of these areas, and this needs to be the focus of promotion to inward investor opportunities. The rail electrification, good skills, competitive salaries, and cheaper housing are all a positive for the Welsh economy. This is certainly a benefit to Wales, and we must exploit the business rates discount from being located outside of London. London West End rates payable are now greater than prime Cardiff Grade A rents. So to conclude, it is looking positive for the South Wales office market, and 2016 has all the signs of being a good year. But this needs to be led by pre-let activity and inward investment. We predict contracting incentives as well as further rental growth for new Grade A and refurbishments. But watch out for the alternatives threat. So moving on to the retail sector. The repositioning of Cardiff's Queen Street has continued with an influx of discount stores. But these 2 lettings illustrate how Queen Street still attracts the key brands. JLL's prime retail instruction, St David's, continues to be the main retail headliner. And H&M made an impressive investment last year, with this being their largest new store outside of London. In addition, commitments were made from the following, with the introduction of new international retailing. This is a continuing trend in other regional centres. In Newport, the £117 million Friars Walk scheme opened its doors last year. Headline rents for the scheme are £110 Zone A for retail and £27.50 for leisure. It has been very positive for the city, and this slide provides a flavour of just some of the retailers and leisure operators that are present. New openings are expected in 2016 from the likes of ZZ, Vodafone and Super Bowl. So moving to Swansea, 2015 was certainly a turning point for the city, with Rivington Land and Acme being appointed as the preferred development manager for the new St David's retail scheme. This will significantly improve the retail offering with a strong emphasis on linking the city and seafront. I will now move on to some more market themes, with vacancy being the first. Vacancy levels are the lowest for the last 5 years, but this mainly relates to the prime retail centres. This is quite the opposite for secondary and tertiary high streets, and there are many areas in South Wales where we've got to the point of no return. These deprived centres will simply have to evolve with a strong emphasis on alternative use. The internet continues to be a key driver in the retail business. John Lewis, for example, predict growth in 50% in online business over the next 5 years. Retailers are therefore responding to this internet dominance by changing their offer and making centres more of an overall destination. Aldi and Lidl, love them or hate them, have doubled their market share in the last 3 years and have opened 5 sites to every one of the big 4, and in some cases acquiring from the big 4. Between them, Aldi and Lidl control 10% of the grocery market. The big boys are certainly under pressure, especially with financial misdemeanour, environmental waste and price point. The price point is an interesting one, given that Aldi and Lidl are venturing into the luxury goods market with items such as lobster, oysters and champagne. Is it all about the price point, or is it that shoppers are looking for something good value, new and quick? So watch this space for new online offerings. Very useful for those snobs not quite brave enough to venture inside. Putting this into perspective, however, Tesco appears to be the hero, having the greatest market share. So to conclude the retail sector, prime retail centres are continuing to lead the way. Cardiff, Newport and Swansea all having real examples. The secondary retail pitches will surely have to diversify to ensure life remains in town centres with a strong emphasis on alternative use. And the supermarket battle will no doubt continue, but will the big 4 remain? I'll now hand you over to Catherine, who will talk you through the planning and residential sector. Thank you.
Thank you, Rydian. So now what about the residential market? In 2015, we saw the housing market move from recovery to cruise control, and in some areas, still accelerating. Housing starts in the UK have increased by 20% over the last 3 years. This is still 30% below both the 2007 peak and the UK government's annual housing target. In 2015, house price increases in Wales were up by 2.6%, with pressure coming down the M4. South Wales is outperforming compared to the rest of Wales. We forecast 2016 to be another year of growth. With average house prices up to 10 times average salaries, getting on the housing ladder is increasingly difficult. Is it therefore any wonder that the private rented sector is the fastest growing tenure? PRS in the UK has grown substantially in recent years and predicted to continue, doubling in size in the next 15 years. And these are some of the investors keen to diversify their portfolios within the sector. The age group having a major influence on the housing market is the grey pound. Just look at these statistics. 17% of the population control half of the total housing equity. Across the UK, that is worth some 800 billion. With all this wealth, they are an important part of the residential market. By selling the family home, they could potentially release 2.6 million homes into the market. With some of the 800 billion equity, the bank of grandma and granddad could buy a one-bedroom flat for the grandchild. and with the money left over, buy themselves a luxury housing with care property. Happy days. But if the bank of grandma and granddad can't afford to buy a flat, where will the grandchildren stay when they go to university? The answer is to stay in student accommodation, with student numbers increasing year on year, particularly overseas students. The first 6 months of 2015 saw an unprecedented number of investment transactions in the student housing portfolios, reaching nearly 5 billion. However, we anticipate that 2016 will revert back to the trend at around 2 billion. With growing occupier demand, we've seen new developers in the South Wales market. With all this investor appetite, have we reached saturation point yet? Saturation point is when all the purpose-built student accommodation reaches 50% of the total student housing market. In simple terms, the full pint glass represents the whole student accommodation market. Taking into account total supply and pipeline, our analysis shows Bristol and Bath are at 40% and Cardiff is just 28%. As Yoda commented on the threat of alternatives, if you take a second-hand 70,000 square foot building in Cardiff, these are the range of values the uses are likely to generate, with student accommodation ahead of the pack. So what about government intervention? In no other sector do we see such interference, whether it is planning, help to buy, reduced tax relief on buy-to-lets, changing stamp duty rates, or indeed sprinklers in new houses. The message for developers and investors is, as always, be careful where you tread. In 2015, we saw the Planning Wales Act receive royal assent. 2016 has seen the Historic Environment Wales Act approved by the Assembly, whilst the headlines will soon be taken by the Future Generations Bill. The Planning Act is a real positive for Wales, strengthening the development plan framework. We now need to implement the Act, in particular, the introduction of strategic development plans as soon as possible. The LDP for Cardiff has recently been adopted, which should help deliver more housing, 41,000 to be precise, over the next 15 years. With only 59 family houses built in Cardiff in 2015, this must be a good thing. This morning I've given you a brief overview of the housing market, together with an update on the Planning Wales Act. In the residential sector, we have seen a strong recovery with inner city living, whether student accommodation or PRS being the driver for both development and investment. There have been significant changes in the world of planning. However, the delivery of the new Act should not be seen as the end of the story. We now must implement these policies, whether through new strategic plans or technical instruments. I now hand you over to Chris.
Thanks, Catherine. So, to the industrial markets. Well, these were the headlines for last year. Take-up was down a little bit over the previous year and was dominated by the manufacturing sector. But we did see both rental and capital value growth. Take-up was actually 22% down on 2014, with the most significant reduction being in the large unit sector. That's shown by the grey on this slide. But those deals that did take place were generally much better in terms of quality than in previous years. We've also seen a welcome return of activity towards the heads of the valleys and also the Swansea area. However, as this slide illustrates, there's a sharp divide between leasehold and freehold transactions. And the majority of large industrial transactions are actually freehold. Now, is this linked to new lease accounting or simply value for money? And actually, I suspect it's just the latter. Now, in previous years, we've highlighted the changing trends in logistics, with the e-commerce boom offering real opportunities for suppliers, retailers, and parcel carriers, if we could deliver a decent distribution park. But the bespoke requirements for high bay distribution warehouses, usually with a raft of dock-level loading doors and large yards, has led to new build activity, including these three projects shown here. Bidvest and Geopost are already operating from their new centres in Chepstow and Wentklug, and Aldi are on site and quite close to finishing their new regional distribution centre in Wentklug. That will be open later this year. And what about the headline inward investment projects in Wales over the past 12 months? Well, they've been mainly manufacturing. And Jeremy, can I put in a request now for my new company car? But having said this, apparently the press release for this car is that the demographic is for an aspirational 30-year something woman, somebody who shops with a Mulberry handbag and probably called Charlotte. Well, there's not many of those in Wales, is there? But there we are. So if Aston Martin is the ideal car for the Vale, and that's quite a coincidence, isn't it? What's the ideal vehicle? What's the ideal vehicle for Merthyr? Well, actually, the right vehicle for jobs in Merthyr is this one. Lindy Industrial Park will now be the UK base for the manufacture and servicing for the Ajax armoured vehicle for the British Army. But yeah, 250 jobs. General Dynamics carried out a UK-wide search and finally chose a building just 10 miles up the road from their base in Oakdale. And actually, all credit to our client, Lindy, because they left the building intact. They didn't strip out the cranes or the plant and machinery, and that made it the ideal building for General Dynamics. So I think, personally, I think that's a really good move on their behalf. The third major inward investment project in South Wales was the letting of a significant part of Imperial Park to Essentra, a manufacturer of pharmaceutical packaging. And this was a 20-year lease, minimum 15-year term, strong rental. So it's good news for Newport, good news for Wales, good news, it's good news for the industrial market as a whole. And we've previously highlighted the lack of Grade A buildings, and this will now impact upon our ability to attract inward investment and actually to retain those existing anchor companies. Grade A occupiers at the end of the day require Grade A buildings. And therefore the decision by St Modwyn to speculatively develop 50,000 square foot at Newport on Celtic Business Park is most welcome, and hopefully this will be the first of many. We also see Charnwood building up in the valleys as well, in Abercynon. So let's see the start of a new development boom. So in summary, we've enjoyed a strong year in the industrial sector and a major turnaround since the low point in 2012. There's healthy demand from our existing occupiers, renewed interest from true inward investment, and bespoke inquiries from the distribution sector. So the challenge is now to deliver new floor space and also to create a pipeline of attractive development sites. I want to round up our presentation with a few points from a policy perspective. And let's firstly look at infrastructure. And the good news is that electrification of the main line is well underway. The section, however, from Cardiff to Swansea remains a political commitment rather than a building project. Now, when you combine electrification and Crossrail, now called the Elizabeth Line, Canary Wharf will be just 2 hours from Cardiff. But just as important, we'll see an increase in capacity to 4 trains an hour. Now, on Metro, the vision first set out by our good friend Mark Barry is now taking shape, with the Transport for Wales company established and plans for a phased upgrade of our local commuter routes. And this is now all about creating this integrated network and aligning development along those routes. And there'll be real opportunity for the property industry in that regard. Now, the M4 Relief Road, it's become as controversial to the Welsh Government as perhaps Heathrow has become to the UK Government. But the problem won't go away, and we must now deliver this crucial project, which provides the route to market for 2/3 of the Welsh economy. Now, there's also a rapidly changing devolution agenda. And for those of you in the room today who joined us last year, you may recall I made mention of the St David's Day Agreement and the fact that the First Minister helpfully noted it wasn't on St David's Day and it wasn't an agreement. Well, the draft Wales bill actually is going the same way. But the Secretary of State for Wales is now promising to reconsider key sections, and we saw an alternative draft prepared by Welsh Government yesterday. And whilst the constitutional debate continues, there are now real changes directly affecting the business environment, and not least in the devolution of taxes and the establishment by Welsh Government of the Welsh Revenue Authority. And perhaps next week's budget will bring further clarity on some of the detail relating to the last 2 points here. Now, only 17 years after national devolution, we see an accelerating picture of regional devolution, in part fuelled by direct city deals funded by HM Treasury. And the proposed city deal for Cardiff Capital Region could potentially bring together over £1 billion of funding from 3 layers of government. But the key here is to carefully target where that funding is invested in order to create a more attractive business environment. And we must ensure that the voice of business is heard in this debate. Now, connected to the city deal, we've also had the announcement for a new innovation or so-called catapult centre. This will be the first catapult in Wales. It's been an ambition for a few years to get one here, and credit goes to Dr. Drew Nelson of IQE, who worked with Cardiff University to lead this project and actually to deliver it. So I've talked in detail about Cardiff, but what about Swansea? And actually, arguably, they're ahead in terms of innovation and joint working. Their proposal is the Swansea Bay Internet Coast City Deal. Snappy, isn't it? But this is seen by central government actually to be high on innovation and is actually a well-regarded proposal. And again, we await the forthcoming budget to see whether there's any traction with respect to either of those city deals. But I've referred to the rapidly changing devolution picture, and city deals, if correctly implemented, with business input, should provide a boost for both Cardiff and Swansea. But the streamlining of economic development, infrastructure and skills remains as important today as it was a year ago, in my view. And actually, this is the more important initiative in the longer term. Now, the Transition Board for the Cardiff Capital Region, chaired by Anne Bynan, has been working hard to build business engagement. And for the region to operate effectively, there is now a need for a strategic development approach. And this will clearly provide real opportunity for the property sector. Yes, there must be recognition as Cardiff as the focal point for the South East Wales city region, but for the region to prosper, then pockets of value and opportunity need to be created in all parts of South Wales. The final point on devolution is one stage that hasn't yet happened, but some of you may have seen the online petition seeking to gather support for an elected mayor for Cardiff. I don't hold a view on it, but in my view, this is the case for and against, and I'll let you choose which way around it is. And that concludes the individual sections of our presentation, but I just want to leave you with some overall thoughts. And Ben provided a reasonably positive overview of the wider UK economy, but highlighted those potential global risks. And Justin highlighted the record year in the capital markets, but it's probably unrealistic to see 2016 making it a hat-trick of record performance. Now, Ridian provided some perspective and balance in terms of the prime and secondary markets, and Catherine talked us through the emerging trends in the residential sector, but reminded us of the issues of planning, and we now look to the Planning Act to deliver positive change. The picture in the world of infrastructure is positive, but it's now all about delivery in order to ensure that our ambitious plans are finally delivered. And finally, the devolution agenda is dynamic, and with an Assembly election in May, and for certain a new economy minister, the year ahead will certainly be interesting. Now, thank you for joining us this morning. As always, many of you I know want to rush off to the office, but for those of you who can join us, we're going to have teas and coffees here as well. And please join us to stay on here. Now, printed copies of our report are available, and thank you to our good friends Carrick for printing this. And finally, these events don't just happen, and I'd like to say a few thank yous. Martin Little and Matthew Wright, wherever you are, you are our editors, our regular editors, and did a sterling job yet again. It's like herding cats with our authors, I'm afraid, but there we are. Thank you. Thank you to Jeremy and Ben for speaking today, and also to our colleagues Michael Green, Paul Baker, David Roberts, Stephanie, who join us from our other offices across our region. But particular thanks to Patricia, who's been our PowerPoint queen this year, and but also the wider team for organising this morning to launch this, our 21st report. And to put that in context, and to make one or two people in the room feel old, our report is now older than some of our work colleagues. Isn't that right, Hannah? So thank you very much. Thank you.